guys, what is going on? Welcome back to my Robinhood portfolio. Today I'd like to talk a little bit about dividend capture. This comes in response to a viewer on the channel, Luis Jimenez, who writes, can you make a video on how you do your dividend captures? So I put out a few videos describing how I do dividend captures in the past. It's been quite some time. I know there's a lot of new viewers on the channel, a lot of new investors who may not know what dividend capture is about. So I thought I'd do an update video here using SPHD, a stock that I've done dividend capture in the past. This is a great ETF, a low volatility index fund with the benefit of a monthly dividend payment. So it makes it perfect for doing some dividend capture. And essentially a dividend capture, you're trying to buy the stock, holding it long enough to collect the dividend, selling it off, hopefully for a profit, and then moving on to the next stock with that capital, buying the stock, holding it until you can get the dividend, and then selling that off. And you basically repeat that over and over again, getting the dividend payment each month. And you're basically increasing your dividend payments by using that capital over and over again to buy and sell stocks without necessarily holding for the longer term. You're simply holding long enough to get the dividend and then be able to sell the stock off for maybe a little bit less than you bought it for or more than you bought it for, which is an added benefit. And then moving on to the next stock in a series of different stocks. So typically you will find different stocks with ex-dividend dates scattered throughout the month. So at the beginning of the month, you can buy a stock, hold it through the ex-dividend date, sell that off, buy the next stock, hold it through the dividend date, sell that off, and then basically repeating that throughout the month. The only caveat is that you need to get a stock that does not drop more than the dividend that is given out to the investor. So as you guys know, on the ex-dividend date, all stocks will drop by exactly the amount of the dividend on the opening of trading. But typically a lot of those stocks will end up bouncing back throughout the day, or maybe the couple days after that they'll be at either the same price or price above for what you bought them for. So you sell them off, make a little bit of profit on the capital gain, but the big profit is on the dividend. You get that dividend, then use that capital to buy the next stock to essentially repeat that process. So for example, SPHD here, as I was saying, is a great monthly dividend stock. It's typically been giving dividends on the 15th or so of every month. The last dividend, ex-dividend date was June 15th. Before that, it was, I believe, May 15th. And then in April, I think it was on the 13th due to a weekend. Before that, I think it was March 15th. So it's basically on the 15th. So there will be an ex-dividend date coming up with this stock on the 15th. I believe 15th is Saturday. So you'll need to buy this stock on Friday the 14th. And then hold that through the opening of trading on Monday, which I believe will be the 17th. Then you can sell it off at any time after that, assuming that the stock will trend back up where you can sell it at the same price or more than what you bought it for, or you can sell it for a little bit of a loss, but the loss has to be less than the dividend in order to make sense. And the other thing behind this as well is you have to pay capital gains rates, taxes, as well as dividend taxes. So if you make, for example, $1 in a dividend payment, you won't receive that dollar necessarily at the end of the year. You'll have to take out whatever your ordinary income tax rate is on that dollar, because doing dividend capture, you never get its preferred or qualified gains. Capital gains are always going to be short-term capital gains, and dividends, you'll never hold the dividend long enough to get the preferred dividend rates as well. So you'll pay more in taxes, so you have to factor that in as well when considering when to sell off a particular stock. So for example, this stock here, SPHD, if we scroll to the bottom, we can see here that I did a dividend payment in the past. You can see $19.99 there, one of the payments. That was essentially given on May 31st, 0.0995 per share. I had 201 shares at that point. If we take a look at my orders here, I went ahead and bought, not that order, I went ahead and bought $7,970 on May 1st here. You can see 200 shares. Then I went ahead and sold off on the 23rd here. Was not able to sell off all shares. You can see entered quantity there. Actually, it's trying to sell off 200, but only 9 shares executed because the price was right at $39.95. Was not able to completely get out of that stock on the 23rd. But on the 24th, you can see here, I sold off the remaining 191 to sell off those 200 shares to complete that dividend capture. So I got the dividend payment, as you saw on the bottom there, of $19.99. Then I was also able to sell the stock off for a little bit of a profit as well, moving from 79.70 to 79, almost 8,000. So about $30 profit there with another $20, about $50 profit or so with that particular trade. So the idea would be, for example, over the last, let's take the last year for example. On the 15th of every month you can see that there's a payment, but you don't see the stock trending down after that. You actually see the stock trending up here, so you can easily buy that stock before the 15th, hold it through the 15th to get that dividend, and then sell off. Same way for April, I think it was April 13th, May 15th. You can see the stock is really not trending back a lot. Every once in a while you'll get into a situation like this. For example, let's say the ex-dividend date is here, the stock trends down. You're going to have to hold the stock through this entire period here. So you may have to hold it from here until it trends back up from the price that you bought it for. That's the risk of doing the dividend capture. If you can't get out of a trade, you essentially have to be holding that capital in that stock for the longer term. So I always would advise that you do dividend captures with stocks that you're more than willing to hold for the longer term. SPHD is a perfect stock to do dividend capture, because if you can't get out of a trade, just hold it for the longer term. It's got a great dividend yield on the bottom here. As you can see, 3.988 dividend yield. So you can hold this longer term. It's got a good market cap as well. And it's an index fund, so you don't have to necessarily worry about holding the stock for the longer term. You can see here it's a great S&P 500. It's also a high dividend, low volatility ETF. So very good ETF to hold longer term. And I actually have a lot of this in my E-Trade account. I get a great dividend yield. It's done relatively well over the last 5 years here, up 86.33%, which you could argue trails or lags behind the overall S&P 500. But if you factor in that great dividend yield, which is compounded on a monthly basis, if you put that money back to work buying more shares of this particular stock, it's essentially exceeding the S&P 500 over this period of time. So it's a great dividend. It's a great stock to hold longer term with capital gains, and it's a perfect stock to do with dividend capture. The only thing you need to do is find about 4 or 5 of these with ex-dividend dates scattered throughout the month. So, for example, month here, you essentially want to find a stock, for example, with an ex-dividend date. If this is time here, let's draw that a little bit better here. So if this is time, you want to find ex-dividend dates throughout the month. Something like that. So you buy the stock here, hold it through the ex-dividend date, get the dividend here, then you sell off here, then the second stock, third stock, fourth stock, buy again here, hold through the ex-dividend date, get the dividend, sell, buy again, hold through the ex-dividend date, get the dividend, sell off. So you're basically just repeating that throughout the month. So that is dividend capture. Very cool way of playing the markets for income. You're basically not looking at growth at all. You simply want to get into a stock, qualify for the dividend, and then get out of the stock as quickly as you can to buy the next stock in your series. And typically I'll do 4 or 5 ex-dividend dates throughout the month, and I try to pick about 30 or 40 different stocks that have these ex-dividend dates throughout the month. So if one stock I can't get in or out of, I can hold through that particular date, and I have a number of different stocks that I can jump into. Some stocks may be trending down, some stocks may not be great buys, so you don't want to necessarily do this with the same dividend stocks every month, but you definitely want to have a large selection of stocks. So once you sell one stock, you have 3 or 4 ready within the next couple days with ex-dividend dates scattered throughout that week. You can jump into those stocks, hold through the ex-dividend date, get the dividend, and then sell off for the next stock. So that is dividend capture. I hope that makes sense. I have put out a couple other videos describing this particular trading method. If you haven't taken a look at those, try to find those. They've been published for quite some time, probably 6 months or so. I think I put one out in about 3 months or so ago. But essentially it's the same as this. A little bit more detail in one of the first ones I put out. I think I was talking about 5 different great business development companies and closed-end funds that have very, very high dividend payments. This particular stock only has a dividend payment of 3.988%, as you see right here. The other stocks that I had previously done the dividend capture in were like PSEC, which has a dividend capture or dividend rate of 12% or so. I think I did a Fallen Angels fund as well. I think it had a dividend of, I think, almost 8%. It's a little bit higher dividend payments with those, but they're a little bit more volatile, and they will tend to trend down after the ex-dividend date, so they're a little bit harder to get out of. Stocks like SPHD here, these great dividend ETFs, much more stable. They're much easier to get out of. That's a big problem with a lot of the dividend capture. You get into a stock, it trends down on the ex-dividend date. If there's not a lot of momentum to bring that stock back up, you can't get out of that stock for quite some time. So instead of doing 4 or 5 ex-dividend captures or dividend captures per month, you can only do maybe 1 or 2 because you have to hold it for a little bit longer term to get out of the stock. So that's the only drawback behind the higher yielding ETFs with business development companies, closed-end funds, ETFs with any yield over 5% or so. This one is good because, like I said, you can get in and out of it fairly easily, move on to the next stock, get in and out of that, collect the dividends, and you can continue to repeat this throughout the month. So that is dividend capture. If any of that does not make sense, please let me know in the comment threads down below. I know I went through that pretty quickly there, but again, I have put out other videos about dividend capture. Please take a look at those. If you have any questions, again, let me know. And kind of with that, not to make the video too long, I'll end it there. As always, if you guys enjoy my videos, feel free to like, share, and subscribe. And until next video, we'll see you then.